Assalamualaikum warahmatullahi wabarakatuh. My name is Rasyidah Binti Abu Mansor. Today, I will present about question number 1A. Great Berhad holds 75% of Big Berhad, which leave the NCI of Big Berhad perhaps to be 25%. This is supported by the acquisition of 75% of ordinary share in Big Berhad for cash consideration of 960 million ringgit, which the amount we must add with the NCI and deduct the value net asset in finding the goodwill in finding NCI. Since we are using proportional method, we need to find the FVNA first for the Big Berhad that 1st January 2018 consists of 3 items: ordinary share capital, retained profit, and ARR, which is as given in the questions. Hence, when we calculate all the 3 items above, it gives us the sum of 1,258 million. So, the NCI could be 25% times with 1,258 million, which gives us 340.50 million. Thus, the goodwill will be 60.50 million, considering of adding the cash consideration with NCI and deduct FVNA. However, it does not stop there, as there is impairment loss charged at the end of 31st December 2021 of 10%. Hence, the remaining goodwill that is transferred to consolidated financial statement would be 40.85 million after impairment loss be deducted from the original 80.50 million ringgit. Next, Great Berhad holds 60% XL Berhad, which leave the NCI to be 40%. This is supported by the acquisition of ordinary share by cash consideration of 322.50 million ringgit to add with the non-controlling interest and deduct it with fair value net asset. But in order to calculate the NCI, we need to find the value net asset consisting of ordinary share capital reserve, profit asset revaluation reserve, and the asset evaluation reserve for the freehold land asset 1st January 2020, which can be found in the provided table. Next, we will multiply the NCI of 50% with the total fair value net asset of 492 million. As a result, we will get a goodwill of 27.3 million, considering that we will get positive value out of consideration transfer being added with non-controlling interest and being deducted with FNV. Big Berhad holding 60% of Good Berhad, which is calculated by multiplying the percentage that we are controlling in Big Berhad, which is 75%, and the percentage of share required, which is 80%. Therefore, the NCI will be 40%. To calculate the indirect consideration transfer of Good Berhad, we will take the cash consideration 180 million and multiply 75%, which is the percentage of shareholding of Great Berhad in Big Berhad. The amount of 135 million ringgit will be put under goodwill column, and then we take the 180 million multiplied with the remaining percentage of 25%, which is equal to 45 million, and it will be put under the NCI column with bracket. Net will be multiplied with FVNA. So, to find FVNA, in 1st January 2021, we must add share capital, retained profit, ARR, and freehold land. It will get 1,075.30 million ringgit. So, we must multiply that with 40%, and we will get 70.12 million ringgit. And as a result, we will get a goodwill of 29.82 million. So next, I will explain about gain or losses arising from the second acquisition of share in XL Berhad on 1 January 2021. Great Berhad acquired another 20% of the ordinary share of XL Berhad. So, as we know, XL Berhad is one of the subsidiary of Great Berhad. Therefore, the acquisition of another 20% of XL Berhad share is an increase in shareholding. In the case of subsidiary to subsidiary, with an increase from 60% to 80% shareholding. Under this case, the calculation of gain orders as follows. First, all of us will take the cost of the second acquisition of 97.2 million that calculate FVNA during acquired date, which is in the 1st January 2021. The first item in FVNA is ordinary share capital at 300 million, which get directly stock bid under XL Berhad. The second item is retained profit 190.4 million we get from Sochi of XL Berhad. The net item is ARR 72 million, which can also get from XL Sochi. Last but not least, ARR freehold land of 3 million, which is surplus or revaluation of freehold land. Total up the amount 300 million plus 119.50 million plus 72 million and 3 million, and we will get net 494 million ring.
For the next question, we need to calculate the consolidated statement profit or loss for the year ended 31st December 2021 for the Great Berhad. At first, to get the sample, we need to get our gross profit. How we want to get the gross profit is by adding all the revenue for the company and minus it with cost of sale. All the information has been given before at the statement and the adjustment that our group has prepared. But here you need to take attention about the minus 60 million and 30 million because there is sold of good happen with the great and big with Excel. So after do all the thing, we will get 310.5 million for the gross profit. Next part is we will minus all the expenses and plus our income to get the profit before tax for the question. All the information also have been calculated and has been given from the question and the adjustment that been calculated by our group. So you will get 215.72 for the profit before tax, and we will minus this taxation to get the profit after tax. The taxation also we can take directly from the statements of profit or loss given in the question for the full company, and after that we will get 152.12 for the profit after tax. After that, we will plus our other comprehensive income, that including the increase in revaluation, 24 million surplus on revaluation of freehold land by 0.7 million, and gain on second acquisition amounting to 31.68 million, and we will get our total comprehensive income of 208.50 million. For the next part, as required by the consolidated to include the profit after tax attributable to of holding company amounting to 108.35 million and NCI of 43.77 million, and if we add, we can get 152.12 million. How we get the 43.77 million? The amount is come from the working. The working of 3 subsidiary company to get the profit after tax attributable to is by adding all the profit after tax, unrealized profit of motor vehicle, over provided depreciation motor vehicle, and some of them have the preference dividend paid, and we times with the NCI for every subsidiaries, and we will get the profit after tax attributable to for each company, and we will add all to get the 43.77 million. Also, not forget to the total comprehensive income attributable to of holding company amount to 164.45, and we will plus with the NCI by calculate 43.77 million plus 0.7 times with 40%, and we can get 44.05 million, and the final answer of 208.50. Don't forget to tally your answer with the profit after tax, also with the total comprehensive income above, to make sure your answer is correct.
Hi, my name is RAUDHATUL Binti RAHMAN, and I would like to proceed the presentation with question 1D, which we prepared the consolidated statement in changes equity as the year ended 31st December 2021. Based on consolidated statement changes in equity, balance brought forward for GRR, GRP, and NCI is calculated same as per working to when the amount of GRR is 510 million, GRP 602.34 million, and NCI is 772.86 million. While for the ordinary share capital and preference share capital, we just take it from statement changes in equity in the question. The ordinary share capital must add with the issuance of shares of 67.2 million. There is no additional changes to preference share capital. Next, GRR will plus with revaluation of land amount at 24.42 million. For the GRP, we must add profit for the year that we can get from the question, add with the changes in shareholding, and minus with dividend paid to NCI, which consists of ordinary share and preference share. The amount already shown in working tree. Lastly, NCI also add profit for the year and acquisition of subsidiary and revaluation of land, while it need to minus with changes in shareholding, indirect consideration transferred, and dividend paid to NCI.
Assalamualaikum, my name is Nur HAMIZAH with HAMIDUN. I will continue with question 1E, which requires to prepare the consolidated statement of financial position as at year end 31st December 2021. We will start with non-current assets, which consist of property, plant and equipment, other investment, intangibles, goodwill and investment in small berhad. For PPE, we will add all the group balance CD in the books, including the depreciation for subsidiaries, increase in fair value and gain on disposal, which amounting to 4,395.8 million ringgit. Other investment is from the total of group balance CD from the books at year end, which amounting to 525 million ringgit. It is the same for intangibles, which also taken from the total of group balance CD from the balance sheet as at the year end, and it gives the total of 333 million ringgit. The goodwill is from the total of goodwill, which we have calculated from question 1A, and it consists of 3 companies: Big Berhad, Excel Berhad and Good Berhad. While for the investment in small berhad, or known as associate company, gives the total of 46.97 million ringgit after considering the calculation for its carrying amount. We move to current assets, which have bank receivables, inventory and cash in transit. For bank, we will add all the group balance CD from the balance sheet, which amounting to 444 million ringgit. Next, receivables consist of the total of group's receivables from the books and reduce the number of goods sold to Big Berhad and Excel Berhad, which all amounting to 390 million ringgit. Moreover, for inventory, the total of group's inventory from the SOFP should be reduced with the total of inventories that is remain unsold by Big and Excel Berhad. And for the cash in transit, it is from the amounts due to Great Berhad from Excel Berhad, which is amounting to 16.2 million ringgit. After calculating the amount of total assets, we managed to get a total of 6,533.44 million ringgit. Let's continue with the equities and liabilities. For equities, the amount for ordinary shares, preference shares, group retained profit and group revaluation reserve are taken from the balance CD of consolidated statement of changes in equity from question 1D, which has been discussed by one of my teammates. It is the same for non-controlling interest or NCI, which amounting to 720.65 million ringgit, which has been calculated in CSO-CIC. For non-current liabilities, the debenture is consists of the total from the balance sheet and reduced with the amount of debentures acquired from Excel Berhad of 45 million ringgit, and it gives the amount of 855 million ringgit. Lastly, from the current liabilities, the payables are the total of group's balance CD from balance sheet except for Great Berhad, which using of new amount after the deduction and reduced with amount that is still not paid in terms of the goods sold to Big and Excel Berhad. This gives the amount of 709.2 million ringgit. While for accruals, the amount of 264.6 million ringgit is the total of group's accrual from the balance sheet. We can conclude that the total for all equities and liabilities are 6,533.44 million ringgit, which give the consolidated statement of financial position as at the year end a balanced total.
So for the question 2, MFRS 10 consolidated financial statements provide guidance for determining where the control exists. The control exists with an entity acquired over another entity which greater than or equal to 50% of the acquiring shares. Related to the case above, on the 1st January 2022, Nel Berhad and Shinji Berhad acquired 50% share respectively in F&E Berhad. Therefore, Nel Berhad and Shinji Berhad are recognized as the holding companies for F&E Berhad. On the same day, they also had appointed one F&E senior and management team member. However, the team manager of Nel Berhad has the right to make key decisions on the important project of the company and how the project is financed. Nel Berhad also have supervisory roles in monitoring the project undertaken and getting related approval from the board of directors. Since both Nel and Shinji Berhad have the right in decision making specific in a management contract, it can be concluded that Nel Berhad and Shinji Berhad have the power and right over F&E Berhad.
Let's move on to question 3A to discuss the accounting treatment of candles acquisition. Firstly, we will look through the definition of MFRS 3. MFRS 3 business combination defines a business combination as a transaction or other event in which an acquirer obtains control on one or more businesses. When control is acquired, the parent firm will be the acquirer and the holding company subsidiary will be the acquiree. From MFRS 10, control can be obtained if the holding hold more than 50% of an investee's voting rights. From this question, the purchase of Candles Berhad by Hendrik Berhad, which is on 1st January 2018, can be categorized as a business combination. Thus, since Hendrik Berhad acquired more than 50% of the voting rights, which is 80% of the equity share of capital, makes Candle Berhad as its subsidiary, while the remaining 20% will be represented as equity and evaluated as a non-controlling interest. 3 shares of Hendrik Berhad were exchanged for every 2 shares of Candle Berhad in order to complete the transaction for transferred consideration. After the calculation, the consideration transferred will be amounted to 27 million ringgit, and the goodwill computed will only apply to the shares of Hendrik Berhad, since the group's strategy is to measure its non-controlling interest at full goodwill. On 1st January 2018, 4.5 million ringgit will be recognized for the non-controlling interest. The amount of consideration transferred must be combined with the non-controlling interest in order to determine the goodwill. To sum up, the transaction has gained a goodwill of 5.5 million ringgit, which will be declared in the consolidated statement of financial position.
Next, I will continue the presentation for question 3 with 3B, which is to calculate the gain or loss in disposal of the shares in Hendrik Berhad. Based on the question above, the planned disposal of 85% of Hendrik's equity shareholding in Candle Berhad for 26 million will have a few effects on the group's financial statement as at 31st December 2021. Firstly, the fair value of remaining shares of 10 million will be included in calculating the group's retained profit. The group retained profit will then be recognized in the consolidated statement of financial position as equity. Next, the goodwill of 5.5 million will also recognized in the consolidated statement of financial position under non-current asset. The impairment of 800,000 will be written off under group retained profit. This will reduce the amount of equity in consolidated statement of financial position. In addition, the gain on disposal of RM 8.68 million will be recognized in the consolidated statement of profit or loss and other comprehensive income. Since Hendrik disposed of 68% of its equity shareholding in Candle Berhad, Hendrik Berhad has become an associate in the company, as the remaining percent that Hendrik Berhad hold less than 50%. We move to the last question for question 3, which is the question required to discuss the effect implementing the plans for group financial statement as at 31st December 2021. The effects of implementing the plan on the group's financial statement as at 31st December 2021 is that we need to determine the goodwill or bargain purchase for Candle Berhad. In the event of a parent disposing of nearly all of the shares, the investment become a simple investment. This is because the holding entity disposes of most of its interest but retains some interest in the investee, although not sufficient for the investee to be classified as an associate or subsidiary. Hendrik Berhad disposed of 85% of its equity shareholding in Kendall Berhad, leaving an interest of 12%, which the working is 80% minus by 85% times 80%. While for the preparation of the group statement of profit or loss, it will include the result of the Kendall Berhad up to the date of disposal of the shares at 30 June 2021. The value of Kendall Berhad net assets will be dropped from 35 million to 26 million. The disposal of Kendall Berhad equity shareholding give rise to the gain on disposal to both Hendrik Berhad's account and group financial statement. The goodwill amounting to RM 5.5 million will be recognized in the consolidated statement of profit or loss. The remaining investment will be carried as its fair value of 10 million in accordance with MRS 139 Financial Instrument Recognition and Measurement in the consolidated financial statement of financial position.
Next, to answer the question 4. The answer for question 4 is Plantain Berhad a wholly owned subsidiary of O&O Berhad because he's purchased 26,000 out of 104,000 shares for 8.5 million from Cindy Berhad, which accumulate to 25% of total share owned by Plantain Berhad. This qualifies Plantain Berhad to be an associate as it is within the range of 20 to 50%. But it also to be noted that although Plantain Berhad is only an associate, Plantain Berhad has the right to participate in the policy making process and intercharge of managerial personnel of Cindy Berhad. From that alone, we can conclude that control is present for Plantain Berhad even though the percentage of ownership is not above 50% and Plantain Berhad on less than a majority of voting right of Cindy Berhad. MFRS 128 Investment in Associate and Joint Venture said that the parent company is required to apply the equity method during consolidation. However, the parent company is exempted from using the equity method under certain circumstances. An example of the occurrence is when the parent itself is fully or partially owned by another entity. This exemption will be applied since Plantain Berhad is fully owned by another entity that is O&O Berhad.
Finally, we are now in a Q&A section. The first question is, what are the conditions for a parent to be exempted from preparing and presenting consolidation? To answer this question, we will look to the definition of MFRS 10. MFRS 10 requires every parent company to present consolidated financial statements, consolidating the financial statements of all the subsidiaries, foreign and domestic. So, what is the exemption for a parent to prepare consolidated financial statement? It is when first, the parent itself is a wholly owned subsidiary or is a partially owned subsidiary and the other owners were informed and do not object to the parent not presenting consolidated financial statements. Secondly, the parent's debt or equity instruments are not traded in a public market or not a listed entity. Thirdly, the parent is not in the process of issuing in a public market its debt or equity instruments by filing its financial statements with the regulatory authorities like the Securities Commission, and lastly, the ultimate or any other intermediate parent produces consolidated financial statements.
For the session Q&A, for the question 2, the things that I will consider in choosing the right joint venture partner. First, integrity. This is because integrity is the important things. Trust will come with time and experience, but integrity has to present from day one. In first meeting, we can know that our joint venture is ready or not. So, for the second thing that we consider is contribution. Personality and character are important, but without some sort of contribution to the deal, the joint venture is over before it even starts. Without contribution from joint venture partner, we cannot discuss and plan what the things that we business wants to do. So, the third thing is skill level. It will be our advantages if our potential joint venture partner has a fundamental level of comprehension so that we don't have to facilitate this learning in addition to our own role and responsibility within the project. We are 100% sure if the partnership will work because she or he know how to do the things that we appoint. So that's all from us. Thank you.